types of derivative markets. Let's get started with different ways the derivatives are traded. We are going to explore a comparative analysis of two main parts, that is the exchange traded and over the counter market, which we often call it as OTC. By the end of this video, you will have a clear picture of how these two function and how they differ from one another. Moving on, you can think of the derivatives ecosystem as standing on two big pillars. On one side, we have organized exchanges which are highly structured, and on the other side, we have direct agreement made privately between two parties. Understanding the OTC market. Now, let's look at what the over-the-counter or OTC market actually is. It is important to realize that this isn't a physical building you can walk into. Instead, it is a way of doing business through a network of dealers spread across the country. Think of it like a massive digital web where intermediaries find matches through a process of bidding and negotiation over phones or computers. Let's talk about who is active in these OTC markets and why they have grown so much lately. Recent leaps in information technology have really boosted the OTC space, making it a favorite for big banks, hedge funds, and major corporations. It is also a place where very wealthy individuals trade, and the speed of modern tech has made these global connections easier than ever before. It's important to understand that the OTC market is a more private, less regulated sphere. Because these deals happen behind closed doors between qualified parties, there is a general assumption that these participants are experts who are capable of looking after their own interests. In this environment, you don't have the same level of external protection because the parties involved are expected to handle their own risks. Let's compare how these OTC and exchange traded contracts are actually structured. On the OTC side, contracts are tailor-made, much like a custom suit, because they are designed to fit the exact specific needs of the two people trading. In contrast, exchange traded derivatives are standardized, meaning they are uniform and identical for everyone in the market, which makes them easier to trade quickly, managing risk and guarantees. Now, let's look at how risk is managed in both areas. In the OTC world, risk management is decentralized, which means you personally bear the risk of the specific entity you are trading with. However, when you trade on an exchange, a central body called a clearing corporation steps in to guarantee that the contract is performed and settled, so you don't have to worry about the other person failing to deliver. Next up is the way prices are actually decided. In an OTC trade, prices are settled through a negotiated bidding process where two parties talk and agree on a number directly. On the other hand, exchange trading uses an anonymous auction where prices are set by the constant interaction of many buyers and sellers on a single platform. Limits and margins. Moving on to the rules, specifically regarding limits and margins. The OTC market generally has no formal centralized limits on how much of a position you can take or how much leverage you can use. Exchange traded markets are much more strictly governed, operating under formal rules to make sure the whole system stays stable and the interests of everyone involved are protected. Visibility and transparency. Now, let's look at transparency and disclosure. Since OTC deals are private, very little information is shared with the rest of the market about the details of those transactions. Exchange traded contracts are the opposite. They are very visible, providing clear market-wide information to everyone regarding the current price and the total volume of trading. Alright, to wrap things up, let's look at this summary that highlights the core differences we've discussed throughout. First, think about how the contracts themselves are constructed. In the OTC world, they are tailor-made to fit a specific person's needs, whereas on an exchange, every contract is standardized, so they are all exactly the same for everyone. When it comes to finding a price, the OTC market uses a negotiated bidding process, essentially a private agreement between two people, while an exchange acts like a big anonymous auction where many buyers and sellers interact at once on a single platform. You'll also notice a big difference in safety. With OTC, the responsibility is decentralized, meaning you have to manage your own risk against the person you are trading with. But the exchange provides a massive safety net because a clearing corporation guarantees that the deal is settled. In terms of visibility, OTC deals are kept private and away from public view, while exchange trading is completely transparent, letting the whole market see the current prices and trading volumes. Lastly, the OTC space is essentially self-regulated with no strict caps on your positions, while exchanges operate under formal, centralized limits and strict governance to help keep the entire market steady. This comparison shows that your choice of market really depends on whether you value a customized fit or a high level of security and transparency.